Hey guys, Max here, and this is, of course, your daily update for yesterday, I think the 10th of January. It was a tough day for stocks at first, but in the end, it turned out all right. We have some economists on Bloomberg trying to gaslight us again, and a couple updates regarding the Fed, so let's just get right into it. So how did the markets actually fare on the first day of the week? Well, absolutely awfully at first, like really badly, but then okay as they rebounded after a pretty huge dip. How big was that dip? Well, it caused the S&P 500 to drop by over 2% at one point and the Nasdaq to fall by almost 4% at one point as well. There were apparently lots of buyers of this dip though, so prices rebounded, and after an absolute sea of red, stocks ended up closing just a touch above or below their opening prices, with the S&P 500 seeing losses of 0.1% over the day and the Nasdaq seeing gains of 0.1%. Now, the Dow Jones, instead of rising as it had been over recent days, actually fell and remained low, ending the day at about a 0.4% loss, which was certainly not what many of us were expecting. The MSCI World Index fell just a touch, down 0.3%, as foreign markets didn't fare quite as well as the US did in the end. Thanks to the late nature of the rally in the US though, we may well see a good night or day for them over in Asia, as this momentum built up in the US carries over a little bit. Personally though, I'm not too sure about that, and I have my doubts about whether or not today will be that positive out east. Now, how did currencies fare? Well, the US dollar had a slight improvement after what had been a slightly disappointing time last week. The euro fell 0.3% after a good previous week, but the yen actually rose a little bit. The Turkish lira seems to have found a certain level of support just above 7 cents, where it doesn't really want to break any lower. To be perfectly honest though, anyone calling this a win is a little bit delusional. The trend is still without a doubt downwards, and I have no qualms putting my view out there that the lira is destined to go even lower. How did bonds fare? Well, US Treasuries lost 1 basis point, but foreign bonds rose a little bit. The British and German 10 years rose 1 basis point each, so not too much actually going on there all in all. Oil actually had a slightly rough day, dropping almost a full percent, though it's still sitting at about $78 a barrel right now, so no one can really complain about its price going too low at the moment. Gold broke $1,800 an ounce on a small rally today, which is nice to say to the least. Now, actually just a bit of a random thing, but I've been looking into PAX-G a little bit more recently, and I'm curious to hear what you will have to say. So if you have any opinions on that stablecoin, then let me know what they are down below. Now on to the rest of the crypto market, and we saw almost a perfect mirror of US equities. Bitcoin, for example, started the day at just below $42,000 and saw a major sell-off that brought the price down below $40,000 and into the $39,000s, which was pretty unpleasant for the maxis out there to say the least. As the day developed though, Bitcoin did recover, again in line with US equities and tech stocks in particular, and it ended the day down from its start but only by a little bit, sitting at around $41,500. Many of the altcoins, however, did not fare so well. They fell even further than Bitcoin, as they so often do, but this time they didn't see such a strong upside. How bad was it in the end? Well, Solana was down about 5% along with Cardano. Ethereum, Binance and Ripple were all down 3%. Some of the more obscure coins like Luna and Avalanche fell around 7%, so it wasn't a great day at all for those people who like to speculate on altcoins. Now, we are getting some really important inflation data out of the US on Wednesday, so all eyes are on that release, and until we see what the state of prices in the country are, I doubt we're going to get any huge moves either side. Personally, of course, I'm expecting the inflation data to be high, not low, and that will probably have an adverse effect on tech stocks in particular. I suspect it won't be a good day for the Nasdaq at all. We're also getting quite a lot of data out of the US this week from other things, with initial jobless claims and PPI data coming out on Thursday as well, and we're going to see the confirmation hearing of Jerome Powell. Now, in other Fed-related news, sentiment regarding the suspected interest rate hikes this year has deteriorated. It's got worse. Of course, the Fed has penciled in 3 rate hikes across the year, with the first one probably in March. They said we should expect to see interest rates at about 0.9% by the end of the year. The markets, however, or in this case I should say analysts, are suspecting more raises than that, and higher ones as well. Are we surprised by this change on this channel? No, of course not. This is exactly in line with our thinking, what we've been talking about for months now. Rate hikes are necessary, and 0.9% interest rates by 2023 would be too little to have any real effect on inflation. It would be too late as well. Morgan Stanley, for example, are saying that because the Fed has already accelerated the tapering, they're likely to accelerate the interest rate hikes as well, because it's on brand and it's something they've already shown they're willing to accelerate. Now, this is especially true if inflation data continues to get worse, as I and most people nowadays expect it will. Now, Powell has come out and made his opening remarks for his confirmation hearing, and he focused his words on inflation and talking about his mandate and how it will be to fight inflation and to stop it from taking root in the American economy. This is, of course, good to hear, but that's just it. We're just hearing what he's saying. Even though I am obviously still skeptical about what he has to say, it will not be easy to fight inflation. It will not be easy for Powell to continue to fight inflation after a major correction is caused by quantitative tightening and interest rate rises in the US equity market. The easy way out will be to turn around, to go back on plans and keep pumping the markets up as they have been doing for so long now. We saw it in 2018, and I wouldn't be surprised at all if we saw it again this year. Let's listen to what Powell has to say, consider his points, the data he uses, and the arguments he makes, but let's push back a little bit as well. Question what he says. Don't take his words as gospel, and let's make sure that we are as formed as we can possibly be so that we can take actions which best ensure our futures are safe. Is that Vice Chair Clarida is going to step down after he's received a whole lot of flack regarding what basically amounts to insider trading down over the pandemic period. There were lots of questions asked about his trades made right as the world was shutting down for the first time, right as markets were crashing, and let's be perfectly honest here, there's a very high chance he was trading on insider information given his position at the Federal Reserve. He was actually influencing the markets that he was trading on. I don't know how he could possibly claim that he was making bets without trading on insider information, but that's his claim. Now, his term was due to end within a couple weeks anyway, so it's not like he's resigning in advance with his dignity intact. He just isn't bothering trying to extend his tenure of influence. Jerome Powell said that he will miss his wise counsel and vital insights. I, on the other hand, will miss the fact that a man in a position of power was allowed to abuse said position of power, profit off of the misfortune of others, and is going to sail off into the sunset, never to answer for his crimes. Maybe he and Nancy Pelosi will meet up for coffee one day and discuss their greatest trades of all time. I, for one, just don't know who will come out on top. In all seriousness here, though, there is some concern that he is one of the last people with influence in the Federal Reserve who actually know economics and know what they're talking about. And some people are afraid that him leaving will lead to poorer policy decisions coming out of the Fed in the future. I'm not sure I personally agree with that. I think that when someone is compromised, it doesn't matter how educated or intelligent or how good their decisions might be if they weren't compromised. They are compromised. They are blinded by the money and their aims change. They no longer try to put out the best policies, but they start to put out the best policies for them that make them the most money. And I think that's probably what we've seen with him over the last year. Now, in COVID news, we have a few developments, starting off with the possibility that the common cold can give you some degree of immunity from COVID. Now, that obviously sounds pretty great, but this is still very early days, and it's all coming off of the back of one study from the UK. Basically, what it found suggests that there is some degree of interoperability for the T cells between some types of the common cold and COVID, which means that some people who have had a cold, if it's the right type, might be less likely to contract COVID. Now, this is obviously very early days. The study was only released a couple days ago, so the results and tests haven't been recreated yet. But of course, if this is the case, then it's good news. Any additional immunity to the virus is obviously a welcome thing, to be sure. If nothing else, then this really does highlight just how young and early all this COVID stuff is still. Even though it's been around for about 2 years now, we're still learning about it, and that's going to continue. Markets will likely latch on to small pieces of news like this and be a little bit bullish, and this story alone isn't enough to see major shifts in the US indexes, for example. But when there are 10 separate stories each like this, and each cautiously optimistic, then the markets will probably react slightly. Now, on the bad, maybe just nothing COVID news actually, there's a new variant detected in Cyprus that is supposedly Deltacron. It's a cross between the Delta and the Omicron variant. Now, the people who put this data out there are insistent that it's real and not a mistake, but it seems like most other researchers don't really believe them, and they say it's probably due to contaminated tests or a mistake made on their research. Obviously, I have no idea about this stuff. I don't know if this stuff is possible or not, if it's likely or not, or what it means for the virus at all. But I can read headlines, and the headlines surrounding this piece of news are obviously not positive. Now, just like the last topic, this news piece alone probably isn't enough to send markets down. But if 10 other pieces similar in nature to this come out, then there is a good chance that markets will react to it. We only have to look back a month and a bit to the early days of December to see an example of just how crazy it can all get based on really nothing news. Before we really knew anything about the Omicron variant, the media was screaming bloody murder, and the markets were dropping, convinced that a new spout of lockdowns were imminent and that the end was nigh. Now finally, on the COVID front, we have a few developments coming from the east. We have news that Hong Kong's attempt to stop the spread of Omicron has failed, and the variant is present in the city, and of course, it's also present in China as well. We obviously don't get much news about this out of China, as is the nature of the media in that country, but this is certainly a space to watch. We know their vaccines are very poor, their cities are very high density, and the CCP has no qualms shutting down entire cities. They have no problem locking away millions of people and even putting people into what basically amounts to internment camps in their fight against COVID. This is not going to be good for China as a whole, and it's definitely not going to be good for their already struggling economy. Finally, now in awful journalistic news, I found this article on Bloomberg titled, "There was no housing bubble in 2008 and there isn't one now." Now, the article is sadly as idiotic as it sounds, to be honest. Of course, there is a lot of debate about the housing market today, and there is no definitive answer as to whether or not there is a bubble. I personally believe that in most of the US, the market is overvalued, and in some specific cities, it is in an outright bubble. In fairness though, we are midway through that bubble, and it isn't a foregone conclusion. The causes and effects are certainly different to what we saw in 2007 or even further back, and so no one really knows what's actually going to happen in the future. As interest rates rise though, as I think they almost definitely will, we do know for a fact that people will be able to afford less home. This will bring pressure on prices, and I believe that real housing prices are going to fall over the next few years. I don't think it's necessarily going to look like 2008. I don't think there are going to be millions of foreclosures. I think the most likely outcome is house price growth drops to 1 to 3% a year, while inflation stays very high at 7 to 10% a year, leading to a reduction in housing costs in real terms. Now, the problem with this article, as I said, isn't that its arguments for today are impossible. It could well be right that there isn't a bubble out there right now. I could be wrong on this front. The problem is that it's claiming there was never a bubble in the past, which we know is categorically, absolutely, ludicrously wrong. Why is this author trying to gaslight us into believing things that just aren't true? Well, I don't know, and it's hard to say, but I wouldn't be surprised if it's the same thing we usually see. A major institution that benefits from booming markets trying to keep sentiment high in order to maintain the bull market, to keep making them rich. Now, this isn't to say that everything on Bloomberg is utter crap, just some of it is. And we shouldn't take what is written on that site or any other media site as gospel. We should question everything we hear, especially when it sounds as ludicrous as this does. Now that is it for the day. I'll see you all again tomorrow. If you enjoyed this video, then leave a like and a comment to bless the YouTube algorithm. If you want more content like this, then check out our Patreon and join our community of investors. You get access to our Discord, loads of exclusive content like insight into my portfolio and buy and sell alerts for all my own investments. There's a link in the description to masterworks.io, a site that allows you to buy fractional shares of art from world famous artists like Banksy, which can be a great way to diversify your portfolio with non-market correlated assets. It's completely free to sign up, you don't have to buy anything, you don't have to hand over any card information, so if that sounds interesting, then make sure to check it out. There's also a link in the description to BLOCKFI, which will give you up to $250 in free Bitcoin when you use it. You can also get 9% interest on stable coins like USDC, which is a far higher rate than you'll get from any savings account these days. Just make sure not to use Tether. Thank you all for the support, thanks for watching, stay stoic, until next time.